Good morning from our global headquarters in New York. I'm Manish Krena. You're welcome to Bloomberg Brief. Let's set that agenda. Softening this stance, President Trump says he'd rather not use tariffs against China. Global stocks rally to a record high, and the dollar drops. Not done yet. The Bank of Japan raises rates and inflation estimates, boosting the yen. And as the World Economic Forum is wrapping up in Davos, President Trump challenges the world to come to the table, negotiate, and deliver. Good morning. We're just shy of those record highs in the S&P 500. The clarion calls from President Trump to the world at Davos. Lower oil prices, lower rates. He knows more about the Fed, and he will be speaking to Jay Powell. The elixir of life, more so for the FX market than the equity market, is rather not putting tariffs on China. The risk is this: the flow into the U.S., fourth week of inflow, $7 billion, driven by large caps. But I take you to the bond market again. Jawboning rates was the stance from the president yesterday. 463 is where we are. Don't forget, we've rallied almost 20 basis points in 2 weeks. We've given some of that back. Hoisington, still very bullish on bonds. They see slower inflation. And to the FX market, this is ground zero for the reaction function from the utterances and the narrative from President Donald Trump. A couple of things going on here. The yuan gets a Trump bump. He dials back, let's say, his veracity, his vocalness on the possibility of tariffs. He'd rather not put them on China. The yen is strengthening, but it's given back quite a bit as the Bank of Japan raises rates to the highest level since 2008. And Morgan Stanley says that there's a silent plurality out there that wants to sell the dollar. We're down 0.5% on those tariff comments. We're also keeping an eye on Texas Instruments. Some stocks on the move this morning. They've given a disappointing earnings forecast, hurt by sluggish chip demand and higher manufacturing. Boeing also falling after preliminary numbers show disappointing revenue as a result of the company's strike and defense business. MicroStrategy rising along with other crypto stocks. This as President Trump signed an executive order creating the working group to advise on crypto policy to the White House. In just a few moments, we'll talk more about that Bank of Japan decision with Mark Dowding of RBC Bluebay Asset Management. Later this hour, JPMorgan's Kelsey Berro joins me around the desk. It is our top story this morning. President Trump softening his tone on tariffs against China, saying this on Fox News: "We have one big power over China. That's tariffs. I'd rather not use it, but it is a tremendous power. It is a tremendous power over China." Mark Dowding is the CIO, the Senior Portfolio Manager at RBC Bluebay. Mark, there's no doubt about it that this week has been quite significant in that we've had no actual tariffs. We've had a softening in the language on tariffs. We have this Goldilocks on steroids narrative from HSBC. Do you share the exuberance for risk? Are you a little bit more judicious?
So look, I think that Donald Trump has been well behaved over the last few days. If you sort of take it at face value and compare it versus what some investors may have been fearing a week ago, but at the same time, I think it would be foolhardy to extrapolate this too far. I think that we're going to see a president that is going to be synonymous with volatility. I think that sometimes what comes out of Trump's mouth can depend on what side of the bed that he's kind of waking up on. And so, although he's sounded more conciliatory around tariffs in the course of the last few days, or we haven't had any early delivery in terms of action, I think it would be pretty foolhardy and complacent to actually sort of jump to a narrative here that you're not going to get anything coming down the pipe over the course of coming weeks, because this has been a very consistent theme coming from Trump and Trump's team, really in the whole sort of process leading up to the inauguration over the course of the past year.
You would say February the 1st for Canada and Mexico is the show and tell moment?
So I think it's an interesting moment. I mean, Trump called out this as a date in the White House, and so that's the end of next week, obviously. So we'd expect to see some news next week in terms of how he looks to proceed there. My own thinking would be that you probably would end up with something like an executive order giving some notification of tariff on Mexico and Canada, but maybe at a lower rate than 25, or with the date pushed well back a few months, and then being contingent on policy action coming out of Mexico City and Ottawa. So we'll wait and see how that evolves. But I think that the message with Trump is that there'll be days where and weeks in markets where we are trading the good side of Donald Trump, and then there'll be a week where we're trading the bad side of Donald Trump. I think that's the reality, and I think that markets can overreact both in terms of being too complacent at times and too pessimistic at other times. But I think it'd be a bit churlish to think that the world's problems are suddenly fixed and this is going to be a bed of roses ahead of us in 2025. So if markets are strong, our sort of general template here has been, look, don't take too much risk at the minute, but be inclined to sell risk when markets are strong and look to buy into market weakness. That's the way you think you make money in 2025.
Well, let's just evolve that, because you have closed you've made it very clear, you've closed your short position on duration. My question to you is the bond market complacent? We've had this rally. I don't think it's a lot of people are fully on board with this rally in terms of positioning. So do you trust this rally that you've had in duration over the past couple of weeks?
Well, I think the thing you need to remember about the bond market is you've got cash rates at the Fed sitting around 4.3. You've got two-year rates sitting around 4.3. So for there to be a big catalyst towards lower yields here, you really need to believe in a Fed cutting cycle. Now, you do get a big Fed cutting cycle, of course, if there's a growth slowdown or recession. That would take rates a long way lower. It would also take risk in the other direction as well. My own way of looking at the US economy at the minute, it continues to have plenty of momentum. So that being the case, I'm not sure that you're going to see much of a move down in inflation. And you could see a situation where rates are kind of going sideways. So my template when it comes to the bond market is, if you're looking at the two-year part of the curve, if you end up with yields rallying all the way down to 4%, so that yields are well below cash, that's where you pick to go short. Similarly, if that two-year rate goes back up to 4.5%, this is where you want to look to get long. But at the moment, we're sitting in the middle of the range. So sit back, relax, chill out for a little bit, and wait for the opportunities to come your way.
Chillax and relax. Let's talk about the JGB and the Japanese market. The hike was as expected. The rates are the highest since 2008. The yen rallied, gave some back. How do you look at this? Do you think that this is a hawkish hike, given the narrative around inflation that they've given to us?
Well, I think the way that we're looking at this is part of a sequence of hikes that we'll see in Japan, which represents a normalization of monetary policy in the country. The one thing that I would sort of say, though, is I feel that too many market participants have got into their mindset that Ueda is a super dovish central banker, partly because he's confused markets and disappointed on timing before. But as you see sort of balance of risks on inflation moving more to the upside, we do expect the BOJ to actually act in a more sort of hawkish fashion going forward. So we certainly are looking for a rate hike again in July to 75 basis points to 1% again next year. When you speak to the Bank of Japan about where they think neutral rates in Japan should be, yes, they've got a broad range, but in the middle of that broad range is actually cash rates around about 1.75%, based on the dialogue that I've been having with BOJ members. So that means that today we're a long, long way from a neutral policy in Japan. There's further to go on Japanese rates. And I feel that investors maybe have overlooked this. It's been interesting speaking to other investors. It feels like people have stopped focusing on Japan because they've been sort of too in the thrall of Donald Trump. So I do think it's time to look a bit more closely at Japan again. I'd be bullish at Japanese stocks, still bearish on JGBs. But also, interestingly, I think this could be the moment where the yen starts to move stronger. The yen is very undervalued, and we've been looking for this closing of rate differentials to occur. And particularly when I look at the valuation of the yen against the euro or against the pound, this is a cross that I really like.
Mark, just before we go, because we're up against the clock, the bullet train has left on being long yen, but what kind of velocity is in that? What kind of move can you see? If you want to be long yen on the crosses, what scale of rally do you expect?
Yeah, so euro yen currently at 161. We see that going to 145 come the end of the year. I think the gains against sterling could be even larger. So this would be the conviction trade of the year for me when it comes to FX.
Mark, thank you very much. Mark Dowding there of RBC Bluebay, giving you his calls for 2025. Other stories trending on your Bloomberg terminal. This is what we got. Shares of Burberry surging after pick up in US demand raised investor hopes For the luxury market recovery, retail sales fell 4%, but the drop was less than expected, with the analysts expecting 13% drop. Still, the label warned that the economic environment remains uncertain and that its transformation is at early stages. JPMorgan increased CEO Jamie Dimon's pay to $39 million in 2024, a year in which the bank beat its own record for the highest annual profit in history of American banking. A regulatory filing shows the board granted him $1.5 million salary and $37.5 million in performance-based incentive compensation. President Trump signed an executive order creating a working group of key agencies to advise on crypto policy at the White House, recognizing the industry's role in the U.S. innovation and economic development. It will submit a report to the president within approximately 6 months, recommending a regulatory framework. Coming up, President Trump softening his tone on tariffs against China.
China's already paying a lot of tariffs because of me. And when you add them up, I would say, they're paying a lot. They paid hundreds of billions of dollars, so they've already started at a higher base. We have one very big power over China, and that's tariffs. And they don't want them, and I'd rather not have to use it. But it's a tremendous power over China.
President Trump shifting to softer tone on tariffs against China. That says he's threatening 10% levies as soon as February the 1st on his second day in office. Chinese assets getting a boost this morning on the back of the remarks. You can see stocks up 0.7%, and the Hang Seng up nearly 2%. Ros Matheson joins me, and the currency obviously reacting. Ground zero for reaction function, Ros, is in the currencies on anything to do with tariffs. Look, before he took office, 60% was the number on the table. Here we are. He really is talking about, I'd rather not have to use tariffs. Markets are optimistic. What's your take?
Well, it's interesting because he has gone back and forth a bit on China, but there does seem to be this bifurcation in a way going on where he's very, insistent on putting tariffs on countries like Canada and Mexico, very strong comments yesterday about Europe. But on China, he's taking more of a slow approach, if anything, and a bit of reluctance to come out very quickly with any kind of action against China. And that's perhaps he wants to take a wait and see approach when it comes to the relationship with Xi Jinping, the president of China. There's been a lot of conversations already between US officials in Trump's orbit. Chinese officials talk about deals on things like TikTok and so on. And also, it's very clear that Donald Trump sees Xi Jinping perhaps as a way to lean on Vladimir Putin in Russia to get to the table on Ukraine. He wants Xi Jinping to use his economic leverage with Vladimir Putin because, Donald Trump has promised to bring this war to a close pretty quickly, and now he needs to deliver. So there's all of those factors perhaps going on for Donald Trump. But equally, he can and does change his mind pretty quickly. And if he thinks that the US is being held at a disadvantage when it comes to China, he's got China hawks in his inner orbit as well, including folks like Mark Rubio. He will act on China and he will put tariffs on China. But it's interesting to see that for now, he's taking a slower, more gentle approach.
Well, he went straight, with a mallet towards oil prices and OPEC. OPEC didn't show me much love. Oil, if you look at the chart on oil, down 1.7%. He's made a big call on Saudi Arabia and on OPEC to deliver lower oil prices. How practical is that, or is it more jawboning at the start of more pressure? He's got form when it comes to pressure on OPEC.
He does indeed. He's been saying this for a long time, including in his first term in office, always wanting lower oil prices to benefit the US economy when it comes to things like inflation. So that's a familiar refrain for him. The question is, will OPEC, and particularly Saudi Arabia, which has that really big voice in the room on OPEC, respond? And they've been really, really reluctant when it comes to production to kind of walk back output cuts. And for Saudi Arabia, that's important for its own economy to have perhaps higher oil prices. So you've got Saudi interests here versus Donald Trump's interests, and whether OPEC responds. And maybe Does Saudi Arabia take the call that perhaps we could let a bit more oil go, perhaps let prices go down just a little bit, perhaps as a nod to Donald Trump? But do they fundamentally want significant weakness in oil prices? It doesn't seem so.
No, not at all. They've got Vision 2030 to pay for. It's been slow going on the cabinet picks at these hearings. We've got Rubio over the line, John Ratcliffe over the line at the CIA. What's on the slate for the weekend? Scott Bessent's critically important, isn't it? And it's assumed he'll fly through.
Well, that's right. There's only been a couple so far, so there's a lot in the hopper for the weekend and into next week. You mentioned Scott Bessent, but he's expected by everybody to get through, and that might come on the weekend if the Senate does decide to stick around. I mean, earlier, in fact, we'll have Pete Hegseth probably late this evening in the US. That will be very closely watched because you do have two Republican senators who've come out publicly and said they will oppose his confirmation at the Pentagon. But of course, you need four. You need all Democrats to vote against a nomination and 4 Republicans. And so far, others don't seem to be coming out. But that one probably is obviously trickier than some of the others, given all the backdrop of concerns around his suitability for that role. So you've got Hegseth, you've got Bessent coming possibly this weekend. In the early part of next week, you've got Robert F. Kennedy Jr. on health and human services. He'll have a tough time probably in terms of his views on vaccines. But again, not a lot of no one's really coming out and saying we will oppose his nomination. Tulsi Gabbard, equally for national intelligence, she will get grilled in her hearing, but you're not seeing, Republicans rush out to say they oppose, pretty much sensing the mood music there when it comes to Donald Trump. So it'll be interesting to see how Pete Hegseth goes, but Bessent, as you said, is expected to sail right through.
Maybe these nominations are not the hill for any of them to die on. Unity at the moment behind President Donald Trump. Ros Masterson, thank you very much. Time for the front pages now. This is what's making news headlines around the world. First up, Financial Times leads with President Trump putting pressure on the Fed to cut rates. The Fed has signaled a slower pace of rate cuts this year. Some officials concerned that Trump's plan will hinder their efforts to bring inflation back to 2%. He certainly didn't hide that during his conversation in the Oval Office yesterday. He knew rates a lot better than the person running the Fed. Next up, the Washington Post reports that the Trump administration moving to abolish a Pentagon office responsible for promoting civilian safety in battlefield operations. The Army has begun drafting a proposal to defund and potentially de-establish the Civilian Protection Center of Excellence. The move suggests that incoming Defense Department leaders may attempt to loosen restrictions on military operations worldwide. And Bloomberg, we lead with Boeing suffering another quarter of losses after reporting its results. That was a surprise announcement. Sales came in at $15.2 billion less than the $16.76 billion that was expected by Wall Street. The company's defense business endured a $1.7 billion charge. Benny Camel has been tracking the story. Benny, this is a litter bin of charges and exceptionals. It's the second time Kelly Ottberg has done it. Why is he trying to clear the decks? Do we know anything more about the health of the business after this deck clearing?
Well, the health of the business is not great. I mean, that much can be said. The full earnings are due on Tuesday, very early in the morning in the US. And this was sort of a teaser. It gave us a sense of where things stand. We always knew that the fourth quarter would be difficult. Remember, they had that strike that really destroyed production pretty much throughout the entire quarter. So we knew that the numbers wouldn't be great. What people then noticed was that things weren't looking good, not only in the civil side, but also on the defense side. And that's what has people worried a bit. The stock dropped somewhat after the close yesterday. Had a dismal year last year, so that slide sort of continues. So he's gotten some of the bad news out of the way, but there'll be lots of questions on Tuesday. Just how does he see the path forward? How is he going to get this company out of its rut?
Just square it away for me. He raised $24 billion in capital in the run-up to this before Christmas. Does he need more capital?
Well, for the time being, he seems okay, but just imagine for a moment if he hadn't raised that capital, they would have run out of money at the end of the year. They had another cash burn of $3.5 billion in the fourth quarter. That's marginally better than what people expected, but still, it gives you a sense of just the cash burn rate. So they really needed that money to stay afloat, as it were. And they have that money now. That gives them that safety net to move forward. They've got about $24 billion in the bank. That's still there. So they can move forward. And they're also looking, that's a separate story that we've reported, they are looking at asset disposals. So they do have some room to maneuver, but make no mistake, it's not a lot.
No, there certainly isn't. Benny, thank you very much. Benedict Campbell there on the very latest from Boeing. Quick snapshot of oil. Yesterday was a particularly important day. They're not showing us a great deal of love. That was the line that Donald Trump used when he was at Davos. He called on OPEC to help bring down the price of oil. He called on Saudi Arabia also to assist with that. Oil tanked by 1.7%. That's that drop that you saw there. Small reprieve this morning. Bring down the price of oil. Bring it down now. It is responsible for the war and an enduring war between Russia and Ukraine. So tying the politics of oil to the politics, obviously, of war. Coming up, embrace the current bond market. Embrace your inner bull. That's the view from JPMorgan's Kelsey Berro. From our global headquarters in New York, welcome to Bloomberg Brief. I'm Manish Cranny. Let's set that agenda. Softening stance, President Trump says he'd rather not use tariffs against China. Global stocks rally to a record high and the dollar drops. Not done yet. The Bank of Japan raises rates and inflation estimates, boosting the yen. As the World Economic Forum wraps up in Davos, President Trump challenges the world to come to the table, negotiate and deliver. Good morning. We did make a record high in the S&P 500. There are calls from Donald Trump for lower oil and lower rates. Stocks give a little bit back this morning. You've seen a float, $7 billion into U.S. equities for the fourth week in a row, according to Bank of America. Roll it over to the bond market. As I say, Donald Trump, the President of the United States, calling for lower rates. He's prepared to talk to Jay Powell about that, calling for lower oil prices. We're down a tick there. By the way, the bond house, the vintage bond house, Hoisington, still bullish on bonds. They see slower inflation. Roll it over to the FX market. This is the ground zero reaction to the headline that Donald Trump would rather not use tariffs on China. It doesn't mean that he won't. It's just his current state of play in week one. You can see that the yuan strengthened, and likewise the Bank of Japan raised rates to the highest rate since 2008, and they called for higher inflation estimates. And the dollar dropped, and I love what Morgan Stanley say. There are some silent plurality out there to sell the dollar and buy the euro, buy the yen. The silent plurality. Who are they? Make themselves known. Maybe Kelsey Berro knows who they are from JPMorgan. Brushing off concerns about the prospect of the Fed under-delivering rate cuts. This is what she writes. A resilient economy has led to another year of strong returns for income, with high-yield debt outperforming, and the U.S. aggregate bond index set for a fourth consecutive year. Kelsey is in the house. She joins you around the desk. Good morning. Good to see you.
Good morning.
So
Great
channel my inner bull, and I can achieve that. Can I achieve that bullish return in bonds with a Fed that potentially remains on hold?
Yeah. So when we wrote that at the end of last year, we were doing we were looking back at the year, and the narrative throughout the year was how many cuts will the Fed deliver, and this consistent fear that the Fed would under-deliver on cuts. And I think that that is really missing the point of where we are in the broader cycle of the bond market. Yields are actually quite attractive here, and you don't need the Fed to be cutting rates aggressively to be able to collect carry and get a strong income, strong, steady stream of returns in a fixed income portfolio. So if you look at investment grade credit with yields of 5 to 6%, high yield around 7%, loans around 8%, those are yields that you can achieve with companies that have very strong balance sheets, that have been improving those balance sheets. And you don't need additional Fed rate cuts to collect that income.
So this is going to be a year of where I clip coupon rather than get a pickup?
That is probably most likely the case.
Two things for me happened this week. One, there's this narrative around gradualism. You just heard overnight President Trump saying he'd rather not put tariffs on China, but it doesn't mean that he won't. And there was a very solid 20-year demand auction. There was an auction that went very, very well. For you, when you look at the bond market, which is sending you a more important signal? Because one of them is very variable and one of them is very factual.
Yeah, I think there's a few things that have stabilized the bond market in the last few weeks. It really started with the CPI report. That inflation data is what got us really off the brink. It felt like the move higher in yields was getting to levels that I think were a bit unsustainable. I was looking at the 30-year real yield above 2.5%, approaching 2.6%, which is the highest yields for that instrument really since the inception of the product. So you're getting to these unsustainable levels. The first thing that got us to kind of reconvene was the inflation data. That inflation data, the CPI data, the translation of that data to PCE, which is the Fed's preferred metric, that was all very encouraging. Now, the second thing that came through was there was a lot of anticipation of day one activity from Trump. We certainly got a lot of executive orders, but in terms of their immediate impact on the macroeconomy, I think there was a sigh of relief there. And so those who had positioned very short term, very tactically, those positions have been cleaned out. So from a positioning perspective, we got to very oversold levels, and some of that has unwound, and we've gotten to a place more of stability. This week has been fairly slow. Next week, luckily, things pick up. We have the Fed, we have the PCE inflation report, and we have ECI. So a lot to look forward to, and I think that this stability we've seen in yields around here, let's see how that holds when we start to get new fundamental data. Because right now, all we're doing is speculating.
Yeah, and it's great for headlines, and it fills a conversation. One line that came from Larry Fink in Davos this week, which is the fountain of all conversation this week, is that it would be naive to think the biggest risk, he says, is to believe that we are past the high point in inflation. Now, that is critically important in terms of what kind of bonds you want, whether you want to actually pick up some tips. Tips had the highest yield since 2008 this week at an auction.
Yeah. So there's a couple things that I'm watching with inflation. So we still feel comfortable generally with the disinflation path. The thing that I'm watching is wages. So the wage data to me encompasses really what the Fed is most concerned about in terms of inflation. Because when it comes to tariffs, you know, that's something that's one out of their control. That's not really a demand-led inflation. And what the Fed is concerned about is cyclically oriented inflation. That's what ultimately is going to be sustainable. If you have a one-time price increase, but on the other side of that, you have demand drop off, you know, that's not necessarily the type of inflation that is sustainable. Whereas if there was a reacceleration in wage inflation, that's where you start to get the self-fulfilling type of inflation that the Fed is particularly concerned about. Now, what I'm seeing on the wage front is not yet any signs of a reacceleration in wages. I think actually they continue to moderate. So this is probably the biggest risk for the bond market. It's the thing that we need to be most vigilant about. But at the same time, as it stands today, I do think that we're generally in a 2 to 3% inflation world. It's not a below 2% world, but a 2 to 3% inflation world. And I'd be watching again that labor market and the wage data before I would start to get concerned that we're really seeing a reacceleration in inflation.
And it's interesting because you look at the recurring claims, the highest in 3 years at 1.9 million yesterday. Let's just round off with this. Katie Koch from TCW yesterday, she came up with a great line. Current account deficit here of 67% in the United States is tolerated as an economic miracle. But in France and the UK, it's seen as a financial crisis. The question is this a year when that privilege is challenged, when that privilege of the US bond market is really challenged?
It could happen, but I don't see it right now. So you just highlighted the very strong 20-year auction earlier this week. I mean, it's a sign that there is still fundamental support. There's tolerance. There is the U.S. is the reserve currency, and it's hard to see what is going to come up and replace that. So this may not be the year. But on the other side of the coin, the way I've been thinking about it is you have the deficits and the Treasury, the U.S. government's fundamentals, they've been deteriorating. The deficit has been rising. That's not something that we've historically seen when the economy is operating at such a strong pace. But what it's done on the other side is actually allowed corporations and companies and people to deleverage their balance sheets and make them stronger. And as a bond investor that invests in corporate debt, invests in securitized credit that's linked to the health of the consumer and the consumer's balance sheet, this is actually a time where they have gotten themselves in a very good place. So you have, on one side, companies and people who are in very strong places in terms of their balance sheet. And you have the Treasury, which is not in a good place, but it's in a place that can be supported, at least for some time, because we are the reserve currency of the world.
And of course, we have Scott Bessent coming in as Treasury Secretary, and we have a whole new division called Doge, so the bond market is something else to lean into. Kelsey, thank you very much. Kelsey Berro there of JPMorgan Asset Management on the bond market. Good morning from New York.
We have one very big power over China, and that's tariffs. And they don't want them, and I'd rather not have to use it, but it's a tremendous power over China.
Tremendous power and a beautiful word. President Trump had floated 60% tariff on China on the campaign trail. That was down to 10% when he returned to the White House, and now he says he'd rather not use that card. Meghan Crane is in Washington. It's an interesting shift, isn't it, Meghan, between his preparedness to go full throttle with Canada and Mexico, but his reticence to go sort of DEFCON 6 with China.
Yeah, good morning. I think it reflects, the fact that China has some power in this conversation as well, probably certainly more than Canada and Mexico do, to the size and global influence, size of their economy. And Donald Trump is sort of running into that head first, right? He's talked a lot about tariffs against China and very hawkish on China, but when push comes to shove, he maybe wants to have a friendlier relationship.
Yeah, well, 10% tariffs would knock 1% off the Chinese growth, so that's a repercussion for the world. Now, look, Trump's cabinet, it's set for some controversial hearings over the next couple of days. We think Bessent will be no problem at all, but Hegseth already has had a few dissenters. What's going to be most closely watched for you, Meghan?
Well, so the full Senate is set to vote on Hegseth today. And I will say that by the time they get there, through the get a hearing scheduled, go through that painful process, get a vote scheduled in the full Senate, they're almost positive to be confirmed. I'd be really surprised if he didn't get through today. The Democrats are sort of slow walking this process in order to slow down things on the back end for later nominees. So they need 30 hours between them. So Kristi Noem, for example, won't be voted on until Sunday. But I'm really looking more for the people who are coming up next week, the much more controversial, well, I mean, Hegseth was controversial, but other very controversial nominees who haven't even had those hearings yet.
Yesterday's presentation at Davos, it was a packed room. You couldn't get in there. But he really sort of went hard and heavy on oil and war with Putin, and he tied these two together very well. But he made demands for lower oil prices, more action from OPEC to bring down the price of oil. Do you think this is a starting point for his negotiation with Saudi and Putin?
I'd have to leave a lot of that to our colleagues who are more experts on the oil markets. But I think that, Donald Trump does do this sort of thing a lot, right? He'll put forward his most aggressive stand and work his way back. He comes from a business background, and that's how he does things. He certainly was laying a marker yesterday at Davos, and we'll sort of see what happens going forward, how much power he's able to exert.
Okay, Megan, thank you so much there. Wrapping up the politics, it's going to be a busy weekend in Washington. That is Megan Crane on the ground there. A little bit of breaking news for you from Novo Nordisk. This is what they're saying. The shares rise 8% after some trial results come through. This is on amycretin trial results. This is one of their obesity drug trials. The data that they've given to us is an early stage clinical trial showing that people treated with amycretin achieved an estimated body weight loss of 9.7% in 20 weeks, 16.2% in 28, and 22% in 36 weeks. So this is all about the battle for supremacy in the GLP-1. So on fire this morning on their obesity drug trial. Over in Austin, Tesla has launched a refreshed version of its best-selling Model Y here in the US and in Europe as its efforts to reverse the first annual sales decline in over a decade. The launch series, the version of the new vehicle, starts at under $60,000 and the deliveries are set to roll out in March. Craig Trudell is tracking the story. I mean, this is the first sort of shake-up in look and feel in Tesla that we've seen, and one of the biggest high-volume cars in 5 years. Is it enough to sate those calls for freshen up your outlook?
I mean, I think they absolutely needed to do this with the Model Y. As you say, this is a vehicle that's been out now for half a decade, and I think particularly on the exterior, that vehicle has started to look a little bit tired, and so this is something that every automaker does, and something that I think Musk has sort of bristled at the sort of conventional wisdom that you need to do this, and yet I think we've seen that sort of the rules of the laws of gravity in fact do apply to Tesla, that they can't necessarily get away with leaving the look of their vehicles untouched as long as he might like, and so this is an example of some of the rules that apply to some of the other car makers applying as well to Tesla, that people want a new look vehicle, even if it's really just sort of little tweaks here to the look of the cars that you're making.
It's maybe a touch of the Apple syndrome, nothing prophetically new here, just repainted. Look, they launched this refresh 2 weeks later in the US and Europe than they did in China. Any particular reason on the lag on East versus West? Is it to do with the demand cycle?
Yeah, I think we've seen this actually in the past. Tesla did something similar with the Model 3, and I think in that case it had more to do with the fact that the refresh Model 3 was going to be ready sooner in China, and so it was a pretty straightforward thing. In this case, I think it is interesting because the Model Y it is going to come out in March, both in US, Europe, and in China. So it's not necessarily a case where the Shanghai plant has a head start over the others. I think the simple answer might be that it matters to consumers in China to sort of feel that little extra bit of sort of being treated special, of getting a first look at what's new from Tesla, and it matters to Tesla to sort of signal to its consumers in China, especially given the fact that is where Elon Musk says himself they're facing the most competition. It's the most cutthroat, and they really are having a hard time keeping up with BYD, as is the rest of the industry.
It also comes down to what you believe the true valuation of Tesla is. It's either autonomous driving robo-taxis rather than a lick of new paint and a few tweaks on the car, isn't it? I mean, that's where the core valuation is. That's why Dan Ives has got their max valuation at 650. It is about robo, and it is about autonomous driving.
Yeah, and I do think that is something that we're going to hear, almost certainly next week when Tesla reports earnings, is, the sort of attempt to downplay and get people to pay less attention to this idea that vehicle sales actually dropped last year. I do think Musk kind of wants to have it both ways, where he does want to get people excited about this year and talk about this potential for growth, and yet I don't know that we necessarily have the fresh metal in the showrooms to deliver that. He wants to sort of, offer some cover in the event that he misses his numbers by saying it doesn't necessarily matter whether I'm growing my sales because we're going to make our cars self-driving and the rest of the industry can't.
He certainly does like to have it always, not just two ways. Craig, thank you very much. Craig Trudell there in Washington. We got more earnings rolling in. We got American Express set to report before the market opens. Charlie Wells is standing by. Charlie, what do we expect from Amex? Have they grown the base? Are you loyal to Amex? Good morning.
Good morning, Manus. So the pressure is on for this credit card company. Their shares reached a record price this week. They're up 75% from a year ago. And this is not just a credit card story. This is an Amex positive story. They have got a 53% premium on price to earnings compared to their peers. And a lot of that comes down to what we're expecting to see today, which is strength in fundamentals and consumer spending up. And not just any consumer. These are the ultra premium Amex consumers who are in a lot of ways insulated from some of those price pressures that a lot of the other credit card companies face, and they have seen a little bit of a slowdown in spending. Now, what else investors really like with Amex is that kind of subscription model that this company has. They've got these customers who are willing to shell out almost $700 in fees for credit cards. Amex brings in a bulk of their revenue from those fees, so the pressure certainly is on because that share price has been performing so well recently.
Well, there's certainly a long list of things that you get if you sign up for Amex Platinum here in the United States of America in terms of what you get, buybacks with Uber, etc. But if there is a premiumization to this card, what stands in the way of this share performance given this sort of premiumization of the product?
Man, so there is a lot of downside risk here, right? Because expectations are so high. And I think some of the concern here comes down to credit quality, right? So a long-term play, and this has been really interesting that Amex has been doing, is they have been marketing to Gen Z and millennial consumers in that higher income bracket. Now, of course, that in the long term could create these customers who are customers for life. That is something that Amex has been known for. But in the short term, they've got a little bit more credit risks from some of those more established consumers. We've also got the issue of competition to look out for with Amex, of course. Other credit card companies are well aware of that subscription model. I'm not going to name the name of my credit card, but I have seen them try to roll out some of these, more subscription style features recently. And let's not forget consolidation in this industry, right? We have the news, from last year about that Capital One Discover tie-up, and that merger is rolling along. So the industry is certainly changing. It's paying attention. And of course, any misses today could significantly hurt that share price because expectations have been so high with Amex.
Charlie, thank you very much. Charlie Wells, let's see what the Amex numbers are. They will drop before the bell. I'll cover it during surveillance. Charlie Wells on the earnings. This is Bloomberg. It's Bloomberg Brief. I'm Manus Cranny here in New York. A look ahead for you today. First up, as we've just been discussing, American Express, then First Citizens Bank. They'll report their earnings before the bell. We get to the US PMIs at 9:45 Eastern time, and then you have UMich sentiment and existing home sales coming through at 10 a.m. On the micro movers, this is what we've got for you. Texas Instruments extending their loss as the outlook points to ongoing weakness. Intuitive shares also down after profit margin forecast missed the estimates, and they warned on potential impact from new tariffs could be material. Now, Boeing, they came out with early report. They're talking about defense charges, hammering the fourth quarter earnings, and certainly missing estimates. But the story of the day goes to the yuan and the one line from Donald Trump with Hannity yesterday, which was tariffs. They're a very big power. I don't want to use them. I'd rather not put tariffs on China. That gives the yuan a bit of strength, but the question is, how long does that endure? Surveillance is ahead.